just so you guys know, Greg and I both work for Hilltop Securities Asset Management, and we manage local government funds. So we pretty much do the same thing a lot of you do. And we're dealing with a lot of the same issues, and we have a lot of the same concerns. And so this is really coming from your side of the desk. And this is a completely unprecedented time. I will tell you, we've never seen anything quite like it. I want to start out by talking about interest rates. And just to remind you, it's been 20 months now that the Fed has been at or near zero. They cut 150 basis points in response to the pandemic. And they basically cut the overnight funds rate, which is your pool rates and your money market fund rates, to zero. And we've been here since. We're kind of at a pivot point now. And so that's why this is such an important presentation, I think. The last time the Fed cut to zero was in December of 2008. And if you remember, it took 7 long years before they gradually started to raise that overnight rate. And this time is different. It's not going to be 7 years. It looks like the Fed is going to start raising rates sometime next year, and the big question is exactly when it's going to be. Fed officials are the ones that raise rates, and they've indicated the last time we heard from them that they expect to hold that overnight rate to its current level at zero, at least through the end of 2022 or early 2023. Now that could change. There's a Fed meeting coming up in December. But for right now, it looks like it is going to be later. Now, the market doesn't believe that. So in recent weeks, the market has seen inflationary pressures rise, and it's made the market nervous. And the bond market has decided that the Fed is not going to wait this long, that ultimately they're going to have to hike rates early. So market yields have climbed sharply. Some of the events driving the market, and this is not an all-inclusive list by any means, but it's some of the things that we want to kind of focus on. And the first thing is there's a lot of cash in the system. M2 money supply, which is spendable cash. It's cash in vaults. It's the cash that you carry. It's the cash in your money market funds and at your bank and in checking accounts. That has actually risen by over 35, actually closer to 36% since the pandemic began. And that is remarkable. At any given point in time before the pandemic, you see the money supply rising by somewhere in the neighborhood of 2%. So this is pretty crazy. And in addition, household wealth, which includes things like stock market value and the value of your home, has reached record highs in each of the last 5 quarters. So we feel like this is pent-up capacity to spend to the extent that there are things to buy. Also, right now, you've got unprecedented fiscal response. That's the government response. That's spending by the government in response to the pandemic. And so far, it's been about $6.4 trillion. There's more spending on the way with the infrastructure packages, but certainly never in history have we seen such an increase in the national debt. And that, of course, has also put money into the system, which has all kinds of implications. I already mentioned monetary policy. That's what the Fed does. That's interest rate policy. And they've done 2 things. They've not only cut to zero, but they've also reinitiated quantitative easing. And they did that last year as well. So they were buying $120 billion worth of securities. And when they buy them, they inject money into the system. They take out securities, they pay for them with cash. Now, those have gone to the banks, and the banks have kept those in reserves. But again, it's just more noise that we all have to contend with. As I mentioned, inflation expectations have risen, and that is certainly impacting the market. The Fed is not appearing to be too concerned about that, very ho-hum as far as they're concerned. They believe that this inflation is temporary or transitory, and to a degree it will be, but it looks like it's going to be a lot longer than anybody imagined it would be, and investors have gotten concerned about inflation. They're not buying the Fed line anymore. They're fearful. We're all a little bit concerned. Economic growth has slowed. The third quarter was only 2% GDP growth as opposed to 6.5 the quarter before. That was completely unexpected. Consumers have all that money to spend, but right now goods are not being produced or they're stuck in port waiting to be unloaded. And I think that we mentioned this a little bit later, but as Americans, we spend the majority of our money on services historically. Over the past 7 years before the pandemic, it's been services. And right now, those services are not as available. We're not traveling, we're not going to concerts or sporting events as much as we were. We're buying goods, and there just aren't enough of them. So economic growth has slowed because primarily consumer spending has slowed down. And then finally, there's a big asterisk by this, but the number of new cases has spiked significantly between the end of the second quarter and the beginning of the third quarter. So the fact that COVID cases were rising in the third quarter had a big impact on the idea that economic growth slowed. But over the course of the last month or so actually since early September, the number of new cases have slowed down significantly. Now, having said that, the weather's cooling around the country, and right now, as probably over the course of the last 10 days or so, we're starting to see another increase. And that's kind of how these things go. We sort of expected another wave, and that wave is already starting. As you can see on this next slide, these are new COVID cases in the U.S. You can see the waves. Obviously, last winter was the biggest of the waves. That was really before there was an option to get vaccinated. This next wave that happened, the big one during the summer, was a real surprise. I think as the economy reopened and everybody felt comfortable moving around and flying around, we got a wave that in some parts of the country exceeded that winter wave. And now you can see sort of at the end here, we're starting to pick up again. I want to mention that globally, we're about 3 weeks behind Europe typically. What we see in Europe winds up making its way over here in about 3 weeks. And they're already starting to get a big spike. In Austria, granted a small country, but they're at their highest level they have ever seen. And they're vaccinated at about a 72% rate, which is about 5 percentage points higher than we are here. Germany also has a higher vaccination rate, and they're experiencing right now a big spike. So, that's coming. I know this is very polarizing, the idea of vaccinations and masking and everything else. We're not going to get into that in any way, form, or fashion here. But I will tell you from an economic standpoint, if we do see a big spike in cases and hospitalizations, that's very critical, then people will become more cautious. And whenever people are more cautious, then the effect on the economy is detrimental. So we'll keep an eye on that. That's also very important. And I'm going to pass it off to Greg. Greg and I are going to sort of pass the baton back and forth. I'd already mentioned monetary policy, which again is the policy that the Fed has. And Greg will talk about that in a little bit more detail, but this is one of the responses to, the pandemic.
Yeah, thank you, Scott. So, the Federal Reserve was really the first ones to act when the pandemic began last March. The Federal Reserve is relatively nimble compared to the federal government. So one of the very first things they did was they cut the overnight Fed funds target essentially to zero. Now, this is a very important short-term interest rate. The Fed has a lot of influence over short-term interest rates, and they exercise that through the open market and via their Fed funds target. So essentially, they cut the overnight interest rate to zero. The other thing they did is that they initiated quantitative easing, and this essentially is the Federal Reserve going into the open market and purchasing securities. Currently, and they started this last year, they're buying $120 billion every single month. 80 billion of that is in treasuries, and 40 billion of that is in agency mortgage-backed securities. And obviously that has a tremendous impact on the marketplace, and it's one of the reasons why we saw longer-term interest rates fall as dramatically as we did. Of course, the Fed also implemented a bunch of lending programs and other special measures. And so all that is depicted here. So what you see here is what is called the Federal Reserve's balance sheet, and this is essentially their assets. And it's all the securities they hold, it's loans that they've made that are due to them. And clearly you can see this dramatic spike up in the Federal Reserve balance sheet at the beginning of the pandemic. And then you can kind of see it sort of continues its little stair step higher even today. Now, The Fed at this point has only just begun to what they call taper or reduce their monthly asset purchases. So just in the month of November, they finally announced that they were going to begin to reduce that pace from $120 billion per month. So they're going to lower that. It's going to get smaller until about the middle of next year, when they won't be adding to the balance sheet any longer. But obviously, this has a tremendous impact on the economy. It adds a lot of stimulus to the economy. The next place to act, of course, was the federal government. So, when COVID began, the federal government jumped in and actually, for Congress, acted in record time. We saw a number of waves of stimulus and relief measures, and we've got a number of those detailed here. Obviously the very large ones, the very big ones. The CARES Act is probably the most significant last March, a $2.7 trillion program, put tremendous amount of money into people's pockets and included the Paycheck Protection Program, loans to industry, some Federal Reserve programs, on and on and on it went. But this was really the first of several very major programs. It was quickly followed up a month later with an expansion of the Paycheck Protection Program, some hospital funding and other measures. That wasn't enough. We came back in December of last year, enhanced or extended federal unemployment benefits, had other payments to individuals. And then that wasn't enough. And so then in March of this year, we passed the American Rescue Plan, which again sent checks directly to taxpayers and consumers. And so it goes on. Just recently, President Biden has signed an infrastructure spending plan, another $1.2 trillion program. And as was just mentioned in the presentation before us, the House has passed just this morning the so-called Build Back Better program. So a number of very large federal programs coming into play. And so, of course, that is government spending. So the chart that you see on the screen now is spending by month from the federal government. And you can see that through 2016 and 17 and 18 and 19, federal government spending generally ranges between about $300 and $400 billion per month. Getting up over that $400 billion mark was more of a rarity. It was slowly growing, but then we hit coronavirus, and you can see we spike up here to 980 billion one month. We spike up to 1.1 trillion in 1 month. All the other months in between are now ranging from 400 to 600 billion. And then, of course, we had the American Rescue Plan Act earlier this year at 927 billion. So tremendous amount of federal government spending. The next slide is the M2 money supply, which Scott mentioned a moment ago, and basically this is cash in the system. It's money in circulation, and it's money in checking accounts and savings accounts and money market funds. You can see this long-term trend with just slow, steady growth, and then that gray bar, vertical bar, is the coronavirus recession. And the money supply increased dramatically. And of course, when the Fed and the federal government implement all these programs, that's exactly what happens. So the money supply grows tremendously. And not only did it jump up, but the rate of growth in the money supply has continued at a much faster pace. And that's a result of the Fed's quantitative easing program and the $120 billion per month in purchases that they're making. So all of these programs are putting money in the hands of consumers, and we are a consumer-driven economy. And when people put money in our hands, we tend to spend it. And so we're going to see now in some of the next charts, I'm going to hand it back to Scott, and he'll start to cover some of the impact that we see from consumers going out and trying to spend all this money.
Yeah, and this next slide, I want to mention it. It's a little bit out of place. There's really nowhere to put it, but I want to mention it because this is the Institute for Supply Management surveys. This is purchasing managers across the U.S. Once a month, they get surveyed on all kinds of different issues. And the red line that you see is the service sector, and the blue line represents purchasing managers in the factory sector. And anytime you have a overall number that's above the 50 mark, it indicates expansion, and below 50 is contraction. And it actually tracks the economy reasonably well. Whenever you start to get up around the 60 mark, that historically is extraordinarily high. You rarely saw numbers above 60. What I want to point out is that both purchasing managers, both in the service sector and the factory sector, are so optimistic. They're as optimistic as they've ever been in history. In fact, the service sector managers are at their highest level in the 25-year history of the service sector index at 66.7. And what that indicates is that they're experiencing really strong demand. But unfortunately, what's happened is they're not able to fill that demand, because if you read through these surveys, the comments that are made by purchasing managers are that they're experiencing unprecedented challenges in finding labor in particular, and also supply bottlenecks and higher prices that they're having to grapple with, all kinds of challenges that are preventing them from taking this great demand that they feel and actually producing output. So it's one of many, many big disconnects that are in the system. Service sector managers are very, very upbeat. A lot of it has to do with Americans gaining immunity and going out and about. But service workers have really disappeared. And that transitions really well into employment. Because what the Fed wants is they want the jobs to come back that were lost during the pandemic, and they have not come back yet. So that's one of the reasons that the Fed is keeping rates as low as they are, is that they're very concerned about employment. They're concerned about primarily two things. They have two mandates. The first mandate is stable prices, which in a sense they're meeting. They can't do a whole lot about bringing them down right now, but they are over and done with that. There's no need to keep prices or interest rates low to, boost prices. They're as high as they need to be. The other mandate is employment, and they're not where they want to be in employment. But the Fed is not able to control this as much as they would like. Looking at this graph, you can see that we lost over 20 million jobs when the lockdowns began in April of 2020, and then they came back. A lot of them came back really, really quickly when the economy reopened. But unfortunately, over the course of especially the last several months, the job growth has been very lackluster. And a lot of that has to do with the fact that, it's prior to Labor Day, we could point to the unemployment benefits that in a lot of cases were more than people had earned, especially with fast food workers. So they weren't in any hurry to come back. But we sort of felt like, as most people did, after Labor Day in September, that once the unemployment benefits on the federal level stopped, the people would start to come back and fill those jobs, and they really haven't. So a lot of folks retired on the upper end, retired early. The pandemic had an effect on them where a lot of people probably reevaluated how they felt about life and how long they were going to be around, and chose to retire if that was possible to do so. And then a lot of people who traditionally have come in through immigration channels have not. So there, especially on the lower end, there is a lack of workers, and that is a concern of the Fed, and certainly something that will weigh going forward in terms of their rate policy. This next graph is non-farm payrolls. It's something we look at every month as part of the labor report. And as you can see, that peak at 152.2 million was just before the pandemic began. And, since then, through October of 2021, about 4 million jobs have not returned from where we were before the pandemic began. And frankly, it's even worse than that, because normally you expect growth of roughly 1.5 to 2 million jobs per year anyway. So over the course of the last 18 months or so, we've not had any job growth. Besides this loss, we've had no job growth. And that's a little concerning, because, job growth does impact the economy as a whole. This is the unemployment rate. The thing I want to mention here is that, we're at 4.6% now. During the worst of the pandemic, we're at almost 15%. So in that regard, things are looking pretty good. The unemployment rate is normally where you might consider full employment to be. Now, we had been lower before the pandemic began. We're at 3.5. That was about a 4-decade low, and we're a ways from 3.5. But the thing is, and this is important, I don't think I have it here in this next slide. Let me peek. No, I didn't. You're only counted amongst being unemployed if you're actively looking for work. So there's about 100 million people who are of working age who are not included in the labor force, who don't have jobs and are not looking for jobs. So even though we're at 4.6%, that's not a real critical number. It's not giving us the whole clue. Frankly, if anybody who wants a job right now can probably get a job. There are a tremendous number of jobs available. In fact, I should mention at this point in time, since I mentioned there are 4 million people who short now of where we were before the pandemic, the job openings and labor turnover survey, which may be another slide on down here, and I'll just mention it again if it is, showed 11 million open positions as of July. So there is a real big disconnect between, the number of jobs and the number of people who are seeking jobs. This next slide is unemployment claims. These are actually benefit claims and ongoing benefit recipients. And unemployed benefits recipients total more than 20 million a year ago, and were 12 million in late August. And now we're at about 2.6 million Americans who are receiving some form of unemployment benefits and falling. And the reason that's fallen so sharply is because, again, on Labor Day, the program for the federal program under the CARES Act that paid gig workers and self-employed unemployment checks, which never existed before, came to an end. So, and it came to an end a little bit earlier here in Texas and a number of other states, because a number of states recognized that this unemployment benefit was large enough that people were not going to work because they had a check. So Texas stopped this earlier during the summer, and the federal government actually stopped it on Labor Day. And so that's fallen. With luck, folks who are not receiving benefits will, decide that they're going to take some of these jobs that are available at this point. This is labor market participation. This is what I mentioned before. This is the percentage of the population that is either employed or actively looking for work. And the labor force participation rate is about 61% right now. That's lower than it was before the pandemic struck. So these folks are not coming back. As I mentioned before, over 100 million working age Americans are currently outside the labor force right now. The employment to population ratio is even lower than that. So need to get that up there. This is the job openings and labor turnover survey, the JOLT survey that I had mentioned before. This shows that in July there were 11.1 million labor or job openings. That's fallen a little bit. We're at about 10.4 million now. If you go back to normal times before the pandemic, this was, closer to, 6.8 million. And if you go way back to, the Great Recession, the number of posted jobs were closer to, 2 or 3 million. So we are definitely way, way elevated here. And I can't recall, Greg, did I pass this to you, or? Yeah, I think I passed consumer spending. So I'm going to pass this over to Greg to talk about consumer spending. And I want to say before I do that, here in the U.S., consumers account for about 2/3 of economic growth. So this is a very, very important component of getting back to normal.
And so this chart here shows, this is the retail sales figures. And one of the important things here is that retail sales figures pretty much only include spending on goods. It generally doesn't include spending on services. Now, as you'll see here noted at the top of this slide, the retail sales data does include spending at restaurants, food and beverage sales. So other service categories, Scott mentioned earlier, things like concerts and movies and sporting events, travel, those are all service industry, and those are not included in these figures. Now, the reason this is kind of important is because we shut down a lot of the service sector, and so when people couldn't spend money on services, they instead shifted their spending towards goods, and it's become a really important factor here in the economy the last year, and even still today, although service spending has rebounded. But what you can see, of course, is last March and April, spending completely collapsed, and of course, it did that across both goods and services as we essentially shut the economy down overnight. Now, we did recover rather quickly, and one of the things that you'll note here is that retail sales and spending, at least on goods, has not only recovered, but it has well exceeded the prior trend. So that blue dotted line that you see here is a moving average trend line, and the red line is spending on retail sales. And again, the important thing here is not only has it recovered, but it's recovered to well above its prior trend. Now, why is that? Well, two things. Number one, as I mentioned earlier, people can't spend their money on services, or at least not as much. So they're buying things instead. And then number two is inflation and higher prices. These figures are not adjusted for inflation. So this is what economists call nominal spending. And so when things cost more, we're spending more. So, some of this increase is a result of inflation. But again, I think it's really important to understand that not only have we recovered, but we recovered pretty dramatically. And of course, that has been supported by both the Federal Reserve and its easy monetary policy, and the federal government and all the stimulus that the federal government has thrown at it. The next page, this is the percent change in retail sales on a month-over-month basis. So this is consumer spending essentially 1 month compared to the prior month. And so a lot of these changes are fairly dramatic, but they're also impacted by the timing of some of those government relief measures. Now, again, you can very clearly see the onset of the pandemic in March and April of last year, where we have the big decline. Things seem to recover pretty quickly. When you shut down an economy for a month and a half, and then you kind of reopen, people go back out and they spend things real quickly. Of course, you also had the CARES Act, and then we had, and of course, that's why you see the big spike really last May and June, is spending from the initial onset of the CARES Act and the stimulus checks that were sent. And that supports spending for a while. And then you can see in the winter, last October, November, December, as a lot of that stimulus sort of faded away. And then we had another wave of COVID hit, spending collapses. And then it comes back in January as COVID wanes. And then in March, we've got another stimulus measure from Congress in the American Rescue Plan. So, a lot of back and forth and a lot of up and down. But we're clearly seeing the impact of not just the coronavirus and so forth, but also of those government stimulus measures. More recently, retail sales have been positive. We've had 3 straight months of really good spending. The 1.7% increase in October was somewhat unexpected. And it is reflective apparently of a couple things. Number one, higher prices, as I mentioned earlier. Gasoline stations is a big component of this. So when gas prices are higher, spending at gas stations is higher, and that is reflected in these numbers. And then, of course, there's also some discussion that consumers are starting their Christmas shopping a little bit early because of all the concerns around supply chain and the inability to get a hold of things. So, some of this may reflect spending that's being pulled forward, and perhaps November and December won't be as strong as they have historically as people are shopping earlier in the season. And Scott, the home sale stuff is back to you.
Okay, and I want to mention home sales. I know you guys are super well aware of what's going on in homes. So again, this is another, not only do Americans spend money on goods and services if they're available, but they've spent money on houses. And this is a very, very dramatic effect of so much money rolling around in the system. some of the things I want to mention that I think are just remarkable is that the idea that the time spent, the time that homes are on the market, the average time is now just 7 days. The last time it was measured, which was actually through June 2021, if you go back to the Great Recession, there were homes that were staying on the market for years. So this is pretty crazy. It's caused a lot of home inflation because there isn't enough inventory on the market, because people have the dollars to spend, because there isn't, they're bidding things up. So the S&P CoreLogic 20 City National Home Price Index, which we watch monthly, was up 20% year over year in July. That's for 20 of the largest national markets on average. And in particular, I talked to the city of Phoenix from time to time, and their home prices were up 30% year over year through July. So just remarkable. National home sales in the midst of this boom actually slowed in 2021. Not because the demand wasn't there, but because home inventories are super lean and builders are having trouble finding skilled labor. This is a big problem, because normally home builders would just replace this inventory. They'd be delighted at the idea that sales were so brisk. They'd be delighted at the fact that the prices they could command were so high, except that right now they can't find people to build those homes. And this is going to be an ongoing problem, to be honest with you. And it could get worse if the infrastructure bills are all passed, because, of course, the infrastructure implies that they're going to need skilled labor to build things, roads and bridges. And, I would sure like to see some of this home inventory come back. Shifting to Texas, the average Texas home price in September was $375,000, down from a record $388,000 in June. That's roughly $50,000 above the same period last year. And here in Texas, the inventory problem is bad, if not worse than it is nationwide. Got down to a record low of 1.2 months supply. Never been any lower than that. It's drifted a little bit higher for seasonal reasons. But again, if you go back to 2 years ago, when I would consider housing to be relatively normal, that supply on the market was 3.6 months. So, we're roughly a third of where we were. And, in 2020, during the pandemic, the nation experienced the highest home sales in 14 years. And that takes us all the way back to the housing bubble. So, we'll see how things unfold, but that's the housing front. And of course, when you talk about inflation, that's part of the picture. And, unless we see inventories rise, which of course we have the problem with skilled workers not being around, but home prices should expect to remain elevated for a while going forward. Which brings me into inflation, which is on everybody's mind right now. And just looking at this graph, the blue line is the consumer price index, and that's all items. And on a year-over-year basis right now, we're looking at above 6%. And that's affected the Social Security beneficiaries. They're receiving significantly more going forward, because the COLA increase, the cost of living increase that they received was, 6% or above for this past year, which is, well above the 1.3% from the previous year. That puts more dollars into, the pockets of senior citizens, which certainly is a positive thing. But the rest of this is sort of alarming to people, because, inflation expectations have a tendency to do things like pull purchases forward. Greg had talked about retail sales and this spending that happened that was significantly higher in October. And a lot of that is people fearful that prices are going to be higher later, and they're buying earlier to make sure that they don't get caught on the wrong side of things. And of course, there's also a fear, I should mention, in terms of retail sales, that the goods are not going to be available, that the shelves are going to be bare. So people are trying to get ahead of things. But headline and core consumer price indexes are right now at 30-year highs. So a little bit of anecdotal here, just to give you an idea of where inflation by decade has been. And, of course, none of this really matters in terms of, 1913 inflation over a, period being up as much as it was. But what I want to point out is, since the 70s, in the Jimmy Carter era where inflation was running rampant, it has slowed down significantly to the point where when we got to the period between 2010 and 2019, we're seeing year over year inflation below where the Fed would normally like to see it. So below 2%. In fact, for period below the pandemic, before the pandemic started, we were having periods where inflation was only up, 1.2, 1.5% year over year, which the Fed didn't like. They would have liked to have seen more price pressure. So the general trend is still significantly lower in terms of prices. This is just sort of this aberration that, as much as anything else, has to do with the supply-demand imbalance. The demand is as far as the fact that we all have more money in our pocket, and the supply side, in that factories are unable to produce as quickly as we would like, and everybody's demanding at the same time. There's a global demand for goods, and we're not able to meet that demand at this point. So there is a spike that the Fed's hoping will be temporary. We're not quite so sure. It's going to take a while, but the general trend is downward. I do want to talk about the 60-month average price of gasoline. So if you look at the right side graph, you can see that here in the U.S., we are now at the highest level that we've seen for gasoline pump prices in 7 years. And the Canadian average, which also is on here, we should feel good that we're not living in Canada buying gasoline, because it is also at 7-year highs, but it's significantly higher. And kind of to throw into the mix, especially for folks who are on the lower end of the income scale, spending so much more on gasoline is a tax. It's effectively a tax on your income. It's something that you don't have any choice but to pay. So we'll watch that going forward as well. But gasoline prices are likely to continue to be elevated, I would think, until the spring before we get any relief there. And then GDP. This is economic growth. This is how we all measure this globally and here in the U.S. These are quarter over quarter annualized here in the U.S. So, and of course, we would like to see economic growth somewhere in the neighborhood, I think, year in and year out. It'd be nice to see it closer to 3%. So before the pandemic began, we had growth that was not where we'd like it to be. It was short of the historical average of 3.2%. Quarterly annualized. In fact, it was, regardless of what you've heard, it was, it's the fourth quarter of 2019, before the pandemic began, growth had already begun to slow significantly. Going back a couple of years, we had some growth that was very anemic, below 1%. It did climb. A lot of it has to do with the Fed cutting interest rates in the summer of 2019 because they anticipated a slowing of economic growth. And then the pandemic hit. It hit very, very abruptly. So the first quarter of 2020 growth was negative, significantly negative, at negative 5%. In fact, in years gone by, that would be disturbingly slower economic growth. And then, of course, in the second quarter, it was a record. We've never seen a drop like that on a quarter-over-quarter basis in history. Even going back to the Great Recession, we've never seen it quite that big. And then the economy reopened, and everybody had those dollars that the federal government had lent out, and the Federal Reserve had dropped rates to zero. So all of a sudden we get this great big spike when the economy reopens. Again, never seen anything even close to that spike. And then things settled down a little bit. And, we had some pretty good quarters historically, well above where we normally like to see that. And then last quarter, as I mentioned, because of the Delta variant asserting itself, because the federal government started to reel in some of that accommodation, because there wasn't another stimulus check, in the later part of the summer. For all those reasons, along with the idea that the unemployment measures started to also get reeled in, economic growth slowed. And of course, I guess another thing is Greg had mentioned that part of that had to do with prices being higher. So we didn't buy. It felt like we bought as much. We really didn't. We paid more for the goods that we had received, but economic growth slowed. And now the task is going to be in the fourth quarter of this year to see that move higher. And for the most part, the expectation is that economic growth will return probably closer to that 6% level. And, we'll wait and hope that that's the case. But there are a lot of impediments in the way. There's a lot of noise. There's a lot of reasons why that might not actually play itself out, and we'll have to see whether or not it does. But let me pass it to Greg. What you're going to see in front of you is the yield curve, and the yield curve shape has changed in anticipation of growth in the future.
All right, thank you, Scott. Well, we're gonna shift gears here just a little bit, because the next several slides we're going to talk about interest rates and the outlook and where interest rates appear to be headed. Scott mentioned this is the yield curve, what we call the yield curve, and basically this is just a plot of interest rates over time. So at the left side of the curve is short-term interest rates, so 1 month and then 2, 3, 6 months out, so forth. At the right side of the curve, we have the 10, 20, 30-year rates. So these are U.S. Treasuries and the yields. The sort of yellow gold dotted line that's on the bottom of this is where we were a year ago. So you can see at that time, rates were what we could describe as a fairly flat yield curve, but gradually sloping higher from the short end out over time. More recently, the yield curve has begun to what we call steepen, and so the slope is changed and the shape of the curve has changed. And basically, this is a reflection of the expectation that the Federal Reserve is going to begin raising short-term interest rates. And then it's also the market repricing and demanding higher compensation for more inflation. So as inflation heats up, investors demand more return on their investments. And some of that you're seeing, particularly in what we call the belly of the curve, which is essentially from 3 years out through about 7 years. Now, as you look out longer, interest rates haven't moved up as much. And I talk about we have a higher expectation for inflation, but the fact that yields on the longer end of the curve haven't moved dramatically higher suggests that the market believes that won't be persistent, and that eventually the Fed will rein inflation in and get things back under control. Now, importantly, you can see at the very short end of this curve, inside of a year, very little has changed. In fact, relative to a year ago, much of the curve today is actually lower. Yields are actually below where they were the same time a year ago. And what this tells us is that while the market is beginning to anticipate rate hikes from the Fed, they're not there yet. So we're still at least 8 months, maybe a year away from the beginning of rate hikes from the Fed, and that's reflected here in the shape of the yield curve. This gives us some clues as to what the market is thinking. Now, this table basically takes a lot of that information you just saw and then puts it on a table so it's a little easier to read. But what we're looking at is a range of interest rates, and these are U.S. government, U.S. Treasury obligations. And if you go back to the beginning of the year in January, of course, the overnight Fed funds target is still essentially zero. Technically, it's a range from 0 to 25 basis points, but we're trading very near the bottom of that range. But as you go out, a 6-month Treasury bill was yielding 8 basis points to begin the year, as low as 3 basis points just in September, and about 5 basis points today. A 1-year Treasury bill has moved a little bit higher, opened the year at 10, fell as low as 5, currently sitting around 16.16, that is. And as you go out, you can begin to see that the yields have moved higher in a pretty dramatic repricing more recently. So, the 2-year Treasury note opened the year around 0.12. By September, we had gone up not even 10 basis points to 0.21. And then in just about 6 weeks' time, from late September through mid-November, suddenly we've jumped up over 30 basis points to 0.52%. And the move in the 5-year part of the curve has been even more dramatic. And what's happened, of course, is inflation readings have really heated up. The Fed has begun to taper their quantitative easing program, so they're starting to remove some of that stimulus. And the market has begun anticipating that the Fed could begin hiking rates towards the end of next year, or perhaps even as early as the middle of next year. And so all of that gets reflected in shifting sentiment in the yield curve and where things are on the yield curve. The next slide here is going to give us some indications on, where government and agency yields are. These are basically the primary investment options for a lot of public fund investors. Over on the right-hand side, we've got the local government investment pools. We've noted here TexPool, TexStar, and the Lone Star Government Fund. Essentially, all of those are basically between 1 and 3 or 4 basis points. We do expect that they'll stay sort of in that range until at least the middle of next year, when the Fed begins to talk more openly and the market begins to price Fed rate hikes. So we're going to be stuck here at these low levels in the pools for a few more months. Got on the bottom here, these are what we call the commercial paper pools or the prime pools. So this is TexPool Prime, Logic, Texas Class, and the Lone Star Corporate Fund. And actually, I think this is the Lone Star Corporate Overnight Plus Fund. But nonetheless, you can see that even those, which take on a fair amount of additional risk because of their investments in commercial paper, you're only picking it up an extra 3 or 4, maybe 5 basis points in yield. And over on the left, we've got U.S. Treasuries and government agencies. One of the things you'll note here is that the yields on federal agencies are really no higher, and in a few cases, they're actually lower than U.S. Treasury notes. So the federal agencies such as Fannie Mae, Freddie Mac, the Federal Home Loan Bank are not issuing nearly as much debt, particularly on the short end of the curve, and the spreads or the difference in yield between those and treasuries has essentially vanished at the short end of the curve. So we have been big advocates of investing in full faith and credit U.S. Treasuries as opposed to federal agencies in this environment.
And Greg, I'm going to jump in before you get to the interest rate outlook and just mention, because I know a lot of you, certainly I think a lot of you in that region and a lot of you around the state wind up doing in normal times CDs with your local bank. And what we have found as investors on behalf of local governments is that banks are not offering respectable CD rates at all right now, because like most of us, they are flush with cash. They don't need the money. They're not willing to pay a rate over and above the market to receive your funds because the lending demand isn't there for them. And, I think that over time that'll change. You'll have some better opportunities with your local banks, but for right now, it's nothing personal. They just don't need the cash. We're all kind of in the same boat. Greg, you mentioned the agencies. They don't need the cash. The federal government does. I mean, they're going to pay a fair rate because they've got financing to do. But, a lot of times when you see low rates that are almost insulting, it's simply because the issuers don't need the money right now.
So we'll move on and talk about the interest rate outlook. And we've already covered a fair amount of this already. But, we talk about the Federal Reserve. Obviously, they have a tremendous impact in the market and in interest rates. And we talked about them tapering their quantitative easing program. So they've been buying $120 billion a month. They're going to reduce that. They're going to reduce that by $15 billion per month. That started here in the middle of November. And every month that goes by, the expectation is that they'll trim it by another $15 billion. So, between November and December, they'll buy $105 billion. Between December and January, they'll buy $90 billion. And
Greg,
then
what are they buying? What are they buying that they won't be buying as much of, and how does that impact, the yields that we're all seeing?
They're buying U.S. Treasury obligations, and they buy it all across the curve, essentially from short Treasury bills all the way out to 30-year Treasury bonds. They attempt to buy it in a proportion roughly equivalent to the outstanding shares. So, if 10-year Treasury debt makes up 10% of the universe of outstanding treasuries, they try to buy 10% in 10 years. And so they're trying to spread it out fairly evenly. So currently they're buying $80 billion in treasuries and $40 billion in agency mortgage-backed securities. And they're going to the plan is to cut by 15 billion a month. So they'll start out by taking 10 billion off of the Treasury purchases, which will reduce that to 70, and they'll take 5 billion off the agency purchases, which will reduce that to 35. And then they'll continue that each month going forward. And at that pace, then by the middle of next year, by about June, they'd be done. Now, they can adjust that, and they've left themselves a lot of wiggle room. They could either increase the rate at which they're I shouldn't say it that way. They could taper by a larger amount. In other words, they could reduce their purchases more quickly, which could get them to end the program earlier. By the opposite effect, they could go the other way. They could delay or not reduce those purchases as quickly and thereby extend quantitative easing further. So right now, it looks like they'll probably stay on course and end the purchases by June. And if I was going to guess, one way or the other, I would say they accelerate that taper so that the purchases end more quickly if necessary. I don't think they will, but if I had to pick between one or the other, that's the way I would lean. The important thing too is that they won't change the overnight Fed funds target until they're done with the taper. So they're not going to start raising interest rates until they're done purchasing securities. And again, at this pace, that's sometime middle of next year at the earliest. But it's also pretty likely that the Fed wraps up QE and then pauses and waits and observes for a while before they actually do start raising interest rates. There's a tremendous amount of uncertainty growing over the direction the Fed is going to go, and that's partially a result of inflation and the direction of the economy, but it's also a result of COVID and a result of personnel at the Fed. You've probably heard there's a big debate going on right now in the administration about whether Jerome Powell is going to be renominated for another term as chairman of the Fed. His term expires in January, and there's some question as to whether or not he'll be reappointed or if there'll be a new leader at the Fed. There's also several open positions at the Federal Reserve Board of Governors that the Biden administration will have the opportunity to fill, and those folks vote on the FOMC committee and have some influence over monetary policy. So there's a little bit more uncertainty in terms of that outlook than there normally is. And now it's probably as good a time as any to also mention that we're seeing COVID cases increase in Europe, and that is apparently starting to cause some concern in the marketplace. We've actually seen Treasury yields fall a little bit today, partially a result of what we're starting to see in Europe. So that's something that is going to garner some attention and be something we need to keep an eye on going forward. That'll take us to the Bloomberg interest rate forecast. And so every month, Bloomberg does a survey of economists, and they project where they expect the economy is going and where they expect interest rates are going. And we've shown you here the survey from back in August, as well as the most recent survey from here just a couple of days ago in November. And the reason we did that is we kind of wanted you to see the contrast and see how quickly things have changed. So in just 3 months' time, we've dramatically changed the outlook amongst economists. So if you go back to August, these top two rows is the forecast for the Fed funds rate. Now, the Fed funds target is set at a range. So there's what they call the lower bound and the upper bound. So right now we're at a range from 0 to 25 basis points. And at the survey back in August, economists expected it to stay there all the way through the end of the survey period, which takes us all the way out through the second quarter of 2023. And then if you look at where the forecast for Treasury yields were, for the end of this year, Q4 of this year, was expected the two-year Treasury would be at 29 basis points. And we weren't expecting to see the 50 basis point range in that until at least the middle, maybe even the third quarter of next year. So we fast forward to November, and you look at the bottom here, and we've got it highlighted there, but now you can see that these same economists are expecting at least one rate hike next year, and then quickly followed by another rate hike in the first quarter of 2023. So that's a 50 basis point move from where they were just a few months earlier. And I suspect, this might start to trickle even higher. And then importantly, if you look at the forecast for the two-year Treasury, number one, you'll note that we've already topped 50 basis points on the two-year Treasury when the August survey didn't think we'd see that till at least the middle of next year. And now the forecast for the 2-year Treasury has those yields moving up quite a bit higher, quite a bit more quickly. And of course, that's the market or the economists telling us they expect that inflation and the Federal Reserve are going to have to, or that the Federal Reserve is going to have to react to the inflation readings that they're seeing. So all that is reflected in the market here. And then really the last thing I want to share with you all is what is known as the dot plot. And you'll hear this talked about in the financial marketplace, particularly around Federal Reserve meetings. But the dot plot is members of the FOMC committee, which is the committee that sets interest rates for the Fed, and it's their forecast, it's their expectation. So this is a little bit hard to read, but each dot on this plot represents one of the voting members of the FOMC. And you can see here that in 2021, essentially nobody is expecting a change in policy. So these bars at the bottom, this shows the Fed funds target between 0 and 25 basis points. As you move into next year, however, 2022, this latest dot plot shows about half the members expect that we'll keep rates where we are, and the other half expect that we'll see at least 1 or maybe 2 rate hikes next year. So this is the FOMC beginning to say, hey, I think we're going to start seeing some movement higher in interest rates. Interesting, though, as you look at 2023, one member thinks we're going to hold interest rates at this current rate all the way through the end of 2023. But just about every other member, or most members, expect we're going to see a series of rate hikes. What's interesting, however, is there's no real consensus. There's a very wide range here from as few as 1 hike to as many as 6 rate hikes. So that's a pretty wide disparity. It indicates that there's a great deal of uncertainty even amongst the Fed members themselves. And then, of course, that extends out to 2024, where the range of forecasts and expectations is even wider. Again, with no real central consensus. Now, by and large, most of the FOMC members do expect that interest rates are going to rise. And partially, that's because they kind of have to, because they have to say, look, we expect the economy to improve. We expect inflation to move to our target. We don't expect that we'll have to keep interest rates at 0 forever, because we expect our policies are going to be effective at improving things over time. So, there's a little bit of bias sort of built into this, but it does give us a good indication that the FOMC by and large expects at least some upward movement in interest rates over the next couple of years. Now, it is important to understand this is their expectation for the Fed funds rate, which is a short-term overnight rate. This has nothing necessarily to do with where the 10-year or the 20-year or the 30-year Treasury is going to be. But it's a very important indicator of what the Fed is thinking and where things are going. And it's really, one of the reasons why we're seeing, a little bit of upward pressure on interest rates.
And I will grab the baton back because I think we're pushing our hour here. But a couple of things I want to wrap up is that there is a lot of uncertainty in the market going forward. And predicting interest rates out several years is like a weatherman trying to decide, on a Thursday a year from now, how warm or how cold it's going to be. It's almost a fool's errand. But these are the experts. The dot plot represents the Fed members. What Greg showed you before on Bloomberg was 70 of the nation's top economists. And the expectation is that rates are going to move gradually higher from here. Timing is a little bit uncertain, but the expectation is that things are going to move higher. And there are a lot of hurdles in the way. A lot of things can happen. COVID is still going to be a big influence. Inflation or the lack of inflation is going to color things going forward. So, keep all this in mind. There are a lot of things that we're all considering right now, and it could be that if you were to listen to us 2 weeks from now, there would be a completely different take on things. So, do we have any questions? Yeah.
Yeah, Scott, we did have one question that came in on the chat I'd like us to address, and this is kind of an interesting question, and I'll take the first stab at it, and then I'll hand it over to you. But the question is, what industry had the highest need for jobs? And that's difficult to answer because literally it's every industry. In particular, I'd say it's the service sector, and generally speaking, it's the lower wage industries where they're really having the highest need. We're seeing it in nursing in particular. I was visiting a hospital client yesterday. They've had a tremendous problem hiring nurses, and it's costing them additional dollars to bring on nurses. But we've all seen it in restaurants where restaurants are not opening up fully or struggling with lack of staff. We've seen it in the construction industry. It's hard to pin down and say there's any one industry that has the highest need, because it's really, really very widespread right now.
Yeah,
Scott,
we'll
do
leave
you
it
have
at
anything
that.
you want to add there? Okay. Well, thank you all very much for listening and paying attention. And with that, I think we'll turn it back over to you.